What events could unlock the housing market and turn what has been many years of a strong seller's market into a balanced housing market or even a buyer's market? That's what we're talking about today. Hi, I'm Jessica Genung with Real Broker and the Genung team. I am married to Chris, who is also a realtor. We work as a team and we have 3 kids, Joshua, Bobby, and baby Jackie just turned 1 year old. I can't believe it. And we have a border terrier named Zoe. When is the housing market going to change? That is a question that I get very often. Folks are simply stunned by the rate at which home prices have increased, the hike in interest rates, and the lack of inventory to choose from, which is the main driving force of the price increases. The lack of inventory, that is. When supply is constrained, prices go up. It's basic economics. This is an opinion video, by the way. I'm going to be sharing my thoughts, and we'll be talking about this Market Watch article. It got me thinking about this topic and noodling some of the proposed solutions. We are all aware of the problem. Sellers do not want to sell and give up their low locked-in interest rates back from the COVID era starting in 2020 when the Fed reduced the Fed funds rate basically to 0. This created a home buying frenzy and lots of homeowners refinanced as well with 2 and 3% interest rates. This has become known as the lock-in effect. Currently, not too many sellers want to sell because many of them also have to buy, which would involve taking on a mortgage with a much higher interest rate, sometimes double their current rate or even more. But there are still lots of folks that want to buy, but the lack of affordability is making that not possible for more and more people, especially younger people and first-time home buyers. Some in the government and the lending industry are proposing some creative solutions, and I'll go over those and I'll give you my opinion about all of that as well. Here is the first proposed solution. The White House recently proposed a new tax credit aimed at undoing some of this mortgage lock-in. Under the proposal, sellers of starter homes, defined as homes below the median house price in their county, would receive up to $10,000. It's unclear how effective this policy would be at loosening the mortgage lock-in for 2 key reasons. First, 80 to 90% of sales are existing homes, and both the buyer and seller typically have mortgages. Unless they're looking to become renters, owners of starter homes will have to find another home to buy before they're able to sell. The seller of this other home might not be eligible for the tax credit, as people typically move from starter homes to the next one, which is usually larger and a higher price point. So that all makes sense to me. So even if the tax credit gives flexibility to owners of starter homes, they might still not be able to move if the owners of trade-up homes are still locked in as well. In other words, if only the homeowners staying at one rung of the housing ladder are locked in, this still has consequences for the other rungs. A motivated buyer could induce a locked-in seller to sell by offering them more money. If the owner of a starter home is eligible for the tax credit and the owner of the trade-up home is not, they could split the funds through a higher purchase price. Although $10,000, quite frankly, as far as a home purchase goes, that's not a whole lot of money to be splitting between 2 parties, if you ask me. But that leads to the second reason to be skeptical about this policy. The tax credit is not that large relative to how much low mortgage rates are worth to borrowers. Exactly what I was saying.
This is what I like to call my told you so dance. I told you so, I told you so.
In our research, we estimate that the average borrower would need $50,000 to compensate them for giving up the rate they've locked in. Freddie Mac also estimated this dollar value and put it at $66,000, similar to our estimate. The maximum tax credit of $10,000 is small by comparison, so it might not be enough to encourage even one homeowner to sell, let alone 2. That's what I'm saying. My opinion of this proposal is that it's a terrible idea. This could stimulate buyer demand for the lower end homes, which is not what we need. We already have lots of demand. What we need is more supply, and this will not loosen the supply, in my opinion. This plan could potentially have the opposite result of what it's intended to do. And speaking of having counterproductive consequences, this tax credit could also create more inflation, which would in turn cause the Federal Reserve to keep rates higher for longer. All bad things. The next solution discussed in this article is mortgage assumptions. This is where you could purchase a home where the seller has a low existing interest rate on the loan, and the loan could be transferred to your name, and you would therefore assume the mortgage with the lower interest rate. The Wall Street Journal recently reported, a 3% mortgage sounds too good to be true. In many cases, it is. High interest rates have created buzz around mortgage assumptions, but buyers must wade through red tape. The Market Watch article goes on to explain assumptions rarely happen in practice due to unwilling servicers, as well as high cash requirements. The latter means that even if a home buyer finds a seller with an assumable mortgage, they can only assume what is left of the existing loan. So if home prices have increased or the existing loan has been partially repaid, borrowers have to come up with the difference between the current loan balance and the house price in cash, or take out a second lien at a higher rate. I have not personally done an assumable mortgage transaction, but I know they are possible, and from what I hear, they are quite difficult. In fact, an agent in my area that I'm friends with on Facebook posted just this week that she closed an assumable mortgage transaction, and the crazy part was that it had been in escrow since October of last year. That was 8 months ago. Most buyers do not have that kind of time or patience.
It's been 84 years.
Here is another new idea that has piqued my interest. Back to the Market Watch article. One alternative to assuming someone else's mortgage is to take your own mortgage with you to a new house, a feature that is called Portability and is available in the UK and Canada, for example. Policymakers should encourage servicers to allow borrowers to port their mortgage when moving in exchange for a fee, which should be both more effective and less inflationary than subsidies. Porting would be good news for current borrowers who do not want to give up their low rates, although first-time buyers would still feel the pinch from high rates and high housing prices. By making it easier for homeowners to move and sell, Portability would encourage liquidity and inventory back into the housing market, a first step towards unlocking it from its current gridlock state. I thought this was an interesting idea, although it does sound a little bit tricky and the details would need to be ironed out, of course. But the fact that they do these successfully in other countries has my attention. I found another article on NerdWallet that further explains how porting works. If you'd like to read more, I'm going to leave that down below in the description. I like this idea, but I think it could get complicated because there are lots of different purchase scenarios that would need to be accounted for, and it's not been done before in the US that I'm aware of.
It's never been tried.
No, it's never been tried. It's been tried. A few guys even came close.
This reminds me of 1031 exchanges, which we do pretty regularly and are certainly doable and beneficial when exchanging property, but there is a learning curve to it and it takes skilled professionals to properly advise on the details of these types of transactions. In the case of 1031 exchanges, it takes a third-party accommodator. So what's the best solution of these three that we went over today? Porting is the most interesting to me, but what I personally think will benefit us all the most is when the rates get back down into the 5% range. Anywhere in the 5s is good. And when we get in that range, I expect to see a noticeable uptick in home buying and selling activity. We witnessed this for a short time in our business at the end of 2022. Rates went up very rapidly starting in March of 2022 when the Fed did its first interest rate increase since 2018. By the end of the summer, many folks thought the rapid interest rate increases was going to crash the housing market, and many sellers decided to quickly list before that happened, and many buyers pulled back on purchasing, waiting to see what was going to happen. Rates came down into the 5s towards the end of summer 2022. This dip in the chart right here is the time frame that I'm referring to. This was a brief buyer opportunity for many of my clients, especially my new construction buyer clients, because we started to see some great new incentives from builders that also thought the market was headed for trouble. Prices were also declining a little bit at this time, but it was short-lived because once we hit the next spring selling market, the buyers decided that the market wasn't actually crashing, and they decided to get back in the game, and then prices started to rise again. Let's wrap this up, and if you made it this far, I appreciate you. If the government wants to try to help the current housing shortage, they could develop a plan to help current homeowners port their mortgage to their new home. We don't know how long we are going to be in this higher for longer interest rate environment, and I don't think it's wise to be overly optimistic on the timing of rate cuts because we just don't know. So let's get a plan together for the current reality and see if porting can help loosen the inventory. And also, let's encourage more new construction building because we know that's another key to ending the housing shortage. I want the decision to buy a home to be a no-brainer for people, and especially young people trying to buy their first home, like it was for me when I bought my first home in Murrieta back in 2010. I had a decent but not great paying job, and we were still able to buy a home and get started building for our future and laying the foundation to start a family. The direction things have been headed has not been good for younger people, and it's really being talked about in the news lately, and the stats have been sad to read about how much longer they're having to live at home, and the mental health stats seem to be declining as well. To end on a positive note, things, they don't stay the same forever. Markets, they go up and down. Spring follows winter. We will get through it, I'm sure. My goal is to help educate you on what's going on and help you make the best decisions for you and your family, given our current circumstances. As always, feel free to reach out to us if you have any questions, and we always love to hear from you. We'll see you next week. Bye.